Hi there, welcome to Kneppy Invest. I was not going to do a video on Dubber, no plans to do a March quarter Appendix 4C for this company, simply because Dubber burned through $9 million of cash in the one quarter. This company was a market darling for a while because the revenue growth in this business was extreme, really impressive revenue growth. And at one point in time, the market only cared about revenue growth. That's the only thing they cared about. And that's why the valuation of this company went above $1 billion at one point in time. But times have changed, and the market doesn't care about those companies that can show they can increase revenue. They only care about those companies that can show they are profitable, that can show they are free cash flow and operating cash flow positive. And Dubber has not reached that stage yet. And as the valuation of this company keeps on falling, and there's no end in sight to the drop in the share price of this company, we will see problems starting to pop up for the company, particularly if they continue to burn through prodigious amounts of cash. They will eventually have to do a capital raising, not yet because they have something like $100 million of cash on hand, but eventually they will have to do a capital raising, and any capital raisings at much lower valuations will be highly dilutive to shareholders, and shareholders won't like that at all. So let's get stuck into this video, looking at Dubber, particularly focusing on their March quarter financial year 22 results. But first of all, what actually does Dubber do? Dubber describes themselves as the world's leading provider of cloud-based call recording and voice AI. And when you talk about any sort of organization, any sort of business, there is a lot of conversations happening, desk calls, call centers, video calls, mobile calls. And Dubber enables these companies to catch any conversation, voice, video, chat on virtually any service and turn it into actionable insight. So, because sort of I can understand where Dubber is coming from, why this might be useful. Me personally, I have no use for what Dubber provides, but because of the revenue growth in this company, seems like there are people out there, organizations out there, who do see the benefits of what Dubber is providing. Dubber was founded in 2011 and listed on the ASX. It was a backdoor listing via Crucible Gold, and that was in March 2015. So Dubber has been around on the ASX for over 7 years. And to be honest with you, I didn't know much about Dubber when they actually did backdoor onto the ASX. And one of the reasons I really wasn't focusing on this company was just they had really low receipts, but those receipts have grown significantly over the past 3 or 4 years. CEO and co-founder is Stephen McGovern. He has a 3.2% stake in the company. One of the major shareholders is BlackRock. I'm not sure if this is the BlackRock, but BlackRock Australia have a 4.2% stake in Dubber. Now we get to the market cap and the valuation of this company. So 1 year ago, and I think I did do a video on Dubber about 1 year ago. So in June 2021, the share price of Dubber was $2.95, which gave a valuation of this company $700 million. And that was not the share price high. In fact, I'll show you a chart. Last time I did a video 1 year ago, and the share price was in a well-defined uptrend, and the share price actually kept on increasing. I think at one point in time, the share price went above $4 for this company. And I think even the valuation, the market cap of Dubber, was above $1 billion at one point in time. Now, the share price is down to 59 cents, which gives a market cap of Dubber 180 million. So the valuation of this company has fallen significantly over the past year. Shares on issue have also increased significantly over the past 4 or 5 years because this company is burning through a lot of cash and they need to do continuous capital raisings. So shares on issue have increased from 78 million to 305 million. Fortunately for Dubber, they do have something like $100 million of cash on hand, so they will be able to burn through cash without doing further capital raisings. But because of the amount of cash they are burning through, there is potential they would need to do a capital raising in the next few years if they don't change their business model. And the ticker code for Dubber is DUB. Now let's have a look at the financial state of the company, focusing on revenue, operating cash flow, and profit after tax for the first half of financial year 22. We'll also compare those numbers to the first half of financial year 21. If we just focus on revenue growth, things are looking pretty good for Dubber. Revenue more than doubled from 7.3 million to 16.2 million. But that's where the impressive stuff comes to an end, apart from the cash on hand. Because when you focus on operating cash flow and profit after tax, things have gotten worse from 1 year ago. Operating cash flow went from being negative 6 million to negative 20.2 million, and the loss making of the company increased significantly from negative 8 million to negative 31.2 million. But they do have a lot of cash on hand, $97 million of cash on hand. So there is no threat of a capital raising within the next few months, even the next year, because they have a lot of cash to burn through. But if they continue on this trajectory of burning through a lot of cash, within the next 2 years, they will have to do a capital raising. And if the valuation and the share price of this company keeps on falling, it will be a significantly dilutive capital raising. Now, analyzed recurring revenue is growing, and this is one of the things a lot of these type of companies do focus on. And in fact, annual recurring revenue at the end of quarter 3 financial year 22 was sitting at 55.1 million, up 62% on the previous corresponding period. So that's another positive for Dubber to focus on, is that increasing annual recurring revenue. But again, the market is not concerned about that sort of thing. They want to see these type of companies becoming profitable, becoming operating cash flow positive, becoming free cash flow positive, and Dubber is a long way from that. Now, to exemplify how, in my opinion, this company actually has gone backwards over the past year, I'm going to focus on the 2 most recent March quarter results. In this slide, we'll look at financial year 21, and in the next slide, we'll look at the most recent March quarter results for financial year 22, focusing on cash receipts, also on operating cash flow. So if we go back 1 year ago, Dubber did receive $6.6 million in cash receipts, but because they are spending a lot of money, they were operating cash flow negative by $5.5 million, which meant the cash on hand at this point in time was $37.7 million. So obviously, because they have $97 million of cash on hand right now, they did do a significant capital raising during the past year. Now to looking at the most recent March quarter results for financial year 22, and this was not good reading. So even though receipts did grow by $2 million from last year, we saw some significant increase in costs, particularly product manufacturing and operating costs, up by more than cash receipts. So that was up 2.3 million. Staff costs were almost up double than the increase in cash receipts. That was up 3.5 million. Advertising and marketing costs up 600,000 from a fairly low base. I think it was something like $100,000 1 year ago. And the only positive thing when it comes to spending was that administration costs actually was down 100,000. But if you look at the majority of costs, up by over $6 million compared to cash receipts up only $2 million. So this company was spending significantly more in this particular March quarter than they were 1 year ago. And that meant this company was operating cash flow negative by almost $10 million in this one quarter. And if you look at the first 9 months of financial year 22, they were operating cash flow negative by $30.4 million. And because they are burning through so much cash right now, cash on hand fell from 108.5 million to 97.4 million. So at this point in time, it seems like the company's management doesn't really care about spending all this money. They are only caring about cash receipts and revenue growth. And unfortunately for Dubber, and unfortunately for their shareholders, cash receipts and revenue are not growing at the same rate as the spending of this company. So something has to change. Now, there were some stuff in the commentary that was a little bit hopeful for shareholders. It does seem like the management is starting to realize they need to show some scale. They need to show some operating leverage. But I need to see proof that they can achieve some scale, that they do have some operating leverage. At this point in time, they are not showing it to the market. They are not showing it to shareholders. And that's why the share price of this company is falling like a rock. One of the impressive things about Dubber has been the significant growth in receipts, particularly in 2020 and 2021. If we go all the way back to when they backdoor listed onto the ASX So that's going all the way back to 2015. Receipts back then were like $30,000, and we didn't see much growth in receipts from 2015 all the way through to 2018. But then we started to see receipts growing, and then we saw exponential growth in receipts during those 2 years in 2020 and 2021. In fact, receipts grew from about $1 million all the way to a high of $9.1 million in the September quarter 2021. The last 2 quarters, we have receipts actually pull back to $5.6 million in the December quarter 2021 and $8.5 million in the most recent March quarter. So I'd like to see receipts get above $10 million to stay on this growth trajectory. We have seen receipts growing over the past few years. At this point in time, this could be just a blip, but if it is not a blip, if this is a new trend, that would be disturbing for the company and its shareholders. If we go back to the last time I did a video on Dubber, which would have been based off this chart, the beginning of May 2021, just after they released their March quarter results of that year, things were looking really good for Dubber and its shareholders. In fact, the share price was in a really good uptrend, and the share price really took off in April. In fact, the share price increased from about $1.75 to $3 on the back of some good news from the company, on the back of really good growth in receipts. Even though the company was highly operating cash flow negative, the company and the market didn't care about that. They just liked the growth in receipts, and that's why the share price absolutely took off at this point in time. But times have changed. The market is no longer caring about growth in receipts, caring about growth in revenue. They want companies that are profitable. They want companies that are free cash flow positive, even operating cash flow positive. Now let's have a look at the current state of Dubber and its share price. And this is not good news for the company, not good news for the shareholders, because we have a chart or a share price chart going from the top left to the bottom right. That's complete opposite of what you want to see in share price action of a company. And this particular daily chart goes all the way back to September of last year, when the share price of Dubber reached a high of $4.30. So you could probably argue that was maximum optimism in this company back then. The valuation of this company could have been above $1 billion at that point in time. But sentiment has shifted. The market has changed its tune in regards to these type of companies. And that's why the share price of this company has fallen from $4.30 to a current share price of about 60 cents. And there's no end in sight to the share price depreciation of Dubber in this point in time. The dashed line we have at just under 50 cents is the COVID-19 panic lows. And if we fall towards that line, that could be a real solid support line. I have seen this play out time and time again over the past few months, where the COVID-19 lows act as a real solid support level. If the share price of Dubber falls below that support level on good strength, on high volume, that would be a very bearish sign. And the share price is moving towards those COVID-19 lows as we speak. As we focus on the weekly chart for Dubber, this goes all the way back to August 2018. And the breakout for this company actually happened at the start of 2019, when the share price was around 50 cents. We saw the share price move out of the consolidation period on really good volume, so some good signs there. There was that blip during the COVID-19 financial panic when the share price moved back towards 50 cents, but then the share price took off. And in fact, the share price went from about 50 cents all the way to a high of $4.30, which was reached in September of 2021. So nice looking chart if you exclude the last 9 months, because the share price was in a well-defined uptrend. But times have changed, as I've mentioned a lot. And in fact, if you do look from the period where the share price reached its high in September of 2021 to now, you will see some really high volume in those red bars in the volume section. That is telling us that there is a lot of selling of this company. So the majority of volume we have seen in the last 9 months has been selling pressure. And that pressure has led to the share price decreasing from $4.30 to a current share price of around 60 cents. But again, as I've mentioned in the last slide, if the share price does move and hovers around those COVID-19 panic lows, which was around 50 cents or just below 50 cents, that could be a good potential buying price for Dubba moving forward. But there is a lot to be concerned about this company over the next few years, particularly the cash burn rate. If they weren't burning through a lot of cash and they still had those impressive cash receipts and revenue growth, this would be a way more enticing company, in my opinion. That's all I have for this March quarter, financial year 22 video for Dubba. They are burning through a lot of cash, not $9 million of cash, as I've suggested in this slide. They actually burned through almost $10 million of cash. And the main question I have for this company and its management is, can you increase cash receipts or revenue if you curb spending so you don't have to burn through so much cash? That is the main question I have for this company, because if they can't achieve that, that would be a good reason why the market is selling off this company and has been selling off this company over the past 9 months. If you have a different opinion than mine, if you think the value of this company is really attractive at these prices, even though they are burning through so much cash, I'd love to hear from you. I love to hear different opinions, because if we can listen, and that's the most important thing, listen to different opinions, we can grow as investors or even grow as human beings. So love to hear from those people who are bullish on the future of Dubba. I am not at this point in time. So leave in the comment section of this video if you are like that. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.